OG John AG with you. A staggering $15 trillion has been evaporated from the combined valuations of gold, silver, and the cryptocurrency space. Gold has declined by 15%, while silver has plummeted 38%. Within a mere 24-hour window, over $15 trillion was obliterated. That figure represents 1/2 of the entire United States gross domestic product vanished in a single day. We have just observed the inaugural Sigma 10 occurrence in all of financial history. From a statistical probability standpoint, this event should not transpire within the lifespan of the cosmos itself. The very simulation is demonstrably fracturing, and the process shows no signs of deceleration. Within the cryptocurrency ecosystem, $500 billion has been erased over the preceding 72 hours. Specifically, over the last day, leveraged long positions valued at $2.5 billion have been forcibly liquidated. This establishes today as the 10th most significant liquidation event in the annals of crypto. Bitcoin has fallen 13%, annihilating nearly $265 billion from its total market capitalization. Ethereum collapsed 25%, wiping out $91 billion. XRP declined 22%. Solana crashed 23%. For any newcomers in this space, I will be unequivocal. I do not vend trading signals, mentorship packages, or instructional courses. The original community here is well aware of this fact. Do not approach me seeking directives on where to purchase or divest. That is not our function. We analyze. We scrutinize both facets of every situation. This is an arena for autonomous thinkers who utilize this intelligence in concert with their personal discernment. If you are incapable of that, then the realms of trading and investing may not be your calling. I am OG John AG on both YouTube and Twitter. If you are not following those authentic channels, you are lacking crucial real-time context. We previously examined the potential for a move to $86 and beneath, and that scenario has materialized. The long-standing members of this community are cognizant of this. Remain vigilant. Counterfeit accounts exist that repackage my analysis with fabricated data. I bear no responsibility for their actions. Authenticate the username. Follow the genuine account, because I do not present a singular biased narrative here. No fear, no greed. I have never issued a trading signal or adopted a singular, inflexible side. I provide you with the unvarnished truth, and I have consistently advised you to employ your own intellect. Understand your position and operate strictly on your own terms. Now, this is what you must comprehend. On Friday, we witnessed the metals crash. Silver down 31%, gold down 13.6%. $7 trillion was erased from the precious metals sector alone. I presented you with the irrefutable evidence. JP Morgan shuttered 633 silver short contracts at the precise nadir. Their timing was impeccable. They exited, and now, this very weekend, cryptocurrency undergoes absolute devastation. Bitcoin, Ethereum, everything is cratering. Is this a coordinated action? Is this contagion? Or is this the system disintegrating in real time? Let us link these developments. Friday's 25% silver crash was not merely about Kevin Warsh or dollar fortitude. It transcended that. A fundamental catalyst, certainly, but also a premeditated manipulation utilizing that driver as a trigger. The CME increased margin requirements to 11% on January 28th. Speculators who initiated long positions with $25,000 in margin suddenly were compelled to post $66,000 at $120 silver, precipitating forced liquidation. JP Morgan's February delivery data, indicating they issued 633 contracts at Friday's $78 settlement, implies that major banking institutions covered short positions by purchasing from these forced sellers at the bottom. Concurrently, physical markets in China and India declined to participate at any price point. If JP Morgan covered a substantial short portfolio during the forced liquidation by acquiring from over-leveraged speculators between $78 and $90, they exited proximate to the lows. Physical holders in China and India refused to divest at any price. This establishes a perilous rebound dynamic, characterized by significantly diminished short interest to cap the subsequent advance. That is the metals perspective. Reviewing the analytics, approximately 3 out of 4 viewers are not subscribed. If this uncensored, unfiltered viewpoint is genuinely honing your market perspective and assisting you in cultivating tangible conviction, then activate subscription. That is my metric for gauging the presence and growth of the authentic community. If you are deriving value, contribute an OG John AG in the comment section. That direct feedback is immensely valuable. It enables me and the team to maintain focus on what is genuinely significant to you. If this content is not for you, no offense taken. I do not pursue hollow metrics. I am here for individuals seeking truth, not the sanitized, detached narratives propagated by mainstream outlets. Now, to cryptocurrency. Why is crypto collapsing today? Bitcoin beneath 79,000. This is entirely a liquidity phenomenon. There have been 3 clearly delineated liquidation waves amounting to roughly $1.3 billion over the past 12 hours. In a market where liquidity has been, at best, inconsistent, sustained levels of extreme leverage are creating air pockets in price discovery. Couple this with herd mentality sentiment, perpetually oscillating between extreme bullishness and extreme bearishness, and the price swings grow even more severe. Michael Saylor's corporate strategy is merely 1.8% away from entering negative territory on its Bitcoin holdings. The strategy holds 712,647 Bitcoin, valued at $55.72 billion, acquired at an average price of $76,038. At the $126,000 peak, their holdings were worth $81 billion, despite possessing 70,000 fewer Bitcoin. Should Bitcoin decline below $74,600, Saylor's strategy submerges underwater. That constitutes a major psychological threshold. Permit me to juxtapose recent liquidation events. The October 10th crash, $1.91 billion in liquidations. The Coinbase crash, $1.2 billion. The FTX crash, $1.6 billion. Today's crash, $2.51 billion. This ranks as the 10th largest liquidation episode in crypto history, and it is transpiring immediately subsequent to the most severe metals crash on record. Connect these data points. Here is the mid-video revelation that recontextualizes the entire situation. $15 trillion was flash liquidated from gold, silver, and crypto. The identical weekend media channels inundate the public with Epstein files and World War III threats. Consequently, the pivotal question emerges. Where did the $15 trillion actually proceed? It does not simply disappear. Some entity absorbed it while collective attention was diverted. Markets are not merely manipulated, they are rigged. This constitutes warfare against the public. Regarding World War III threats, Trump has just stated he deployed troops and naval vessels toward Iran, conditional upon Iran's unwillingness to broker an accord with Israel. Qatar's foreign minister, Mohammed bin Abdulrahman Al Thani, arrived in Tehran, reportedly conveying a final communication from the United States to Iran's supreme leader, Ali Khamenei. This is accelerating rapidly, and markets are pricing in geopolitical risk by divesting across the board. The first U.S. bank of 2026 has just failed. This is the initial bank collapse in over 7 months. This is precisely the manner in which 2008 commenced. Smaller financial institutions fell initially, then the entire system followed. The result? Trillions erased. Millions of families devastated. The system is immeasurably more fragile than authorities will acknowledge. The majority of the population is utterly unprepared for the impending impact. $3 trillion excised within minutes. This transcends ordinary market volatility. It is a raid. Where are the SEC and the CFTC? Markets are not just manipulated, they are rigged. Several prominent financial analysts have posited we may witness additional bank, hedge fund, and crypto exchange failures as market conditions constrict. Only the passage of time will reveal the outcome. Now, let us deliberate on potential Monday scenarios. We will begin with the bearish case. If this represents a comprehensive liquidity crisis propagating from metals to crypto to equities, Monday may herald further carnage. Asian markets open initially. Should China, Japan, and Hong Kong all gap down severely, that establishes the tone for European and subsequently U.S. markets. Contagion spreads, triggering further crypto liquidations as participants awaken to losses and engage in panic selling. Additional margin calls reverberate across all asset classes. If Michael Saylor's strategy submerges underwater on Bitcoin, that headline alone could instigate more selling pressure. If more banks are rumored to be troubled following the Metropolitan Capital failure, confidence fractures further. The flight to cash accelerates. All assets are sold. Liquidity evaporates even more profoundly. Iranian tensions could escalate over the weekend. Should a military incident, strike, or any action that amplifies war fears occur, Monday opens in a state of panic. Oil spikes, markets crash, risk-off sentiment dominates. The $15 trillion erased could transform into 20, even 30 trillion as selling cascades. This is the critical element for precious metals. If this is purely liquidation driven by margin calls and liquidity requirements, gold and silver could face another assault on Monday, despite their traditional safe haven status, mirroring Friday and this weekend. During the initial phase of a crisis, all assets are sold as entities scramble for cash. The safe haven bid materializes later in Phase 2, but Phase 1 can persist for days or even weeks in extreme circumstances. The CME could increase margin requirements again on Monday, instigating more forced selling in metals and further liquidations. The paper price could decline further, even as physical premiums skyrocket. We are already observing Shanghai premiums exceeding 43%. If COMEX declines further and Shanghai holds or ascends, that premium could reach 50%. Eventually, the COMEX pricing mechanism loses all credibility. However, reaching that point may be agonizing for anyone holding paper derivative positions. That is the bearish Monday scenario. Now, the bullish case. If JP Morgan and other major banks successfully covered their short positions at the bottom, there remains far less short interest to suppress the next upward movement. Physical holders in China and India are refusing to sell at $78 to $90. They are holding. Delivery demand persists at 2,514 contracts for February. Physical supply is constrained. Should Asian markets stabilize Monday? Should liquidations cease? Should margin calls abate? We could witness a violent snapback rally. Shorts are covered, physical markets are tight. Shanghai premiums at 43% shriek that paper markets are disconnected from reality. The rebound could be rapid and brutal as short covering converges with relentless physical demand. We have witnessed this pattern previously. A massive flush, followed by an explosive recovery. China's January 1st export controls are constricting supply. India absorbed 25% of global production in 2025, demonstrating inelastic demand. The physical fundamentals are exceptionally solid. If the paper liquidation is complete, if weak hands have been flushed, the pathway higher reopens with diminished resistance. Mining equities could potentially double over the next 4 to 6 months as the dust settles and the bull market resumes. Cryptocurrency could rebound Monday if liquidations are exhausted. The 3 liquidation waves totaling $1.3 billion may have purged the over-leveraged positions. If Bitcoin maintains $79,000, if Saylor's strategy remains above water, confidence could stabilize. Herd sentiment pivots back from extreme bearishness to cautious optimism. Liquidity returns. Prices recover. Iranian tensions could de-escalate if the message delivered by Qatar facilitates an agreement. Should no military incident occur over the weekend, should diplomacy prevail, the geopolitical risk premium exits the market. Risk-on sentiment returns. Assets rebound comprehensively. Here is the pivotal consideration. If this was deliberate manipulation, as the data implies, JP Morgan exiting at the bottom, $15 trillion erased while media distracts with Epstein and WW3, then the manipulators have achieved their objective. Weak hands are flushed, shorts are covered, positioning is reset. Now they permit the market to advance. Monday could be positive across the board as the subsequent leg of the bull market initiates. However, this is what I am monitoring. Shanghai futures open Sunday night, our time. If Shanghai silver holds firm or ascends while COMEX is closed, that indicates physical markets are not panicking. If Shanghai gaps down severely, following COMEX lower, that signifies selling pressure is global and authentic. The Asian Open will establish the tone for Monday. Bitcoin activity over the weekend, if it stabilizes at 79,000, holds that level, perhaps even rebounds to 82, 85,000, that is bullish for Monday. If it breaches 75,000 and Saylor's strategy submerges underwater, that is bearish. The crypto activity presently serves as a leading indicator for Monday's risk appetite. Iranian news over the weekend, any military strikes, incidents, or escalations are bearish for Monday. Any diplomatic progress, de-escalation, or accords are bullish. Geopolitical developments move markets, particularly when tensions are this elevated. Banking news. If more banks are rumored to be troubled, if there are weekend emergency meetings, if the FDIC is intervening elsewhere, that is bearish for Monday. If Metropolitan Capital was an isolated incident, if no other banks are failing, confidence is maintained more effectively. Where does this leave us? 3 essential takeaways and we will conclude. Number 1. $15 trillion erased from gold, silver, and crypto collectively. The first Sigma 10 event in history for metals, the 10th largest crypto liquidation ever. This is not normal, this is system-level stress. JP Morgan exited short positions at Friday's bottom. Crypto liquidated throughout the weekend. The question for Monday is whether the liquidation persists or concludes. Monitor the Shanghai Open Sunday night and Bitcoin's activity throughout the weekend. Number 2. The physical paper disconnect has reached extreme levels. Shanghai premiums exceed 43% while COMEX crashes. Physical holders in China and India refusing to sell at any price. Delivery demand at 2,514 contracts. If JP Morgan covered shorts and physical markets are this constricted, the rebound setup is perilous for any remaining shorts. However, if liquidations continue Monday, paper markets could decline further before physical reality reasserts its influence. Number 3. Multiple catalysts are converging. The first bank failure in 7 months. Iranian tensions with troops deployed. Media distraction via Epstein and WW3 narratives. Markets are rigged, not merely manipulated. Monday could proceed in either direction, contingent upon the Asian Open, crypto stabilization, Iranian developments, and banking contagion. Bearish case, more liquidations, margin calls, panic. Bullish case, shorts covered, weak hands flushed, a violent snapback commences. The unresolved tension is this. Were Friday and this weekend the final flush preceding a major bull advance, or is this the inception of a larger systemic crisis? JP Morgan exiting at the bottom suggests manipulation and a planned flush. Yet, 15 trillion erased, bank failures, Iranian tensions, crypto cascading, that resembles something more substantial fracturing. Monday's open will indicate which scenario is unfolding. Conduct your own due diligence. Comprehend the risks. If you are over-leveraged in any asset class currently, metals, crypto, equities, this environment functions as a liquidation machine. Margin calls are indifferent to your investment thesis. However, if you are positioned appropriately, if you understand the unfolding dynamics, Monday could represent either the opportunity of the year or the commencement of something considerably more severe. Remain vigilant. Observe the data. The ensuing 24 hours will reveal everything. Invest utilizing logic, not hype. OG, signing off.